Welcome back to the Deep Dive. It's January 17, 2026. And today, we're doing something. Well, it might sound a little mundane on the surface.
A little.
Okay,
Yeah.
okay, but stick with me here.
Yeah.
Because it's actually one of the most revealing exercises you can do if you want to understand how the world really works.
It's definitely a departure from our usual book breakdowns.
Exactly. Usually, we're tearing apart a bestseller or a research paper. But today, we have a stack of data. Specifically, we are looking at a curated list of commercial real estate listings.
The listings of the week from the Eureka Business Group, EBG.
Right, out of Dallas-Fort Worth, and led by Joseph Goslin.
Mm-hmm.
And you might be asking, why are we looking at ads for buildings? We aren't buying a strip mall today.
You're not.
Well, I might be tempted after this, but that's not the goal. The goal is to use this list as a kind of heat map.
That is the perfect way to frame it. Real estate is the ultimate lie detector for the economy. You can read headlines about inflation or GDP, but if you want to know where the money is actually moving,
You look at dirt.
you look at dirt, you look at bricks, you look at who is signing a 15-year lease and where they're signing it.
So we're going to decode these listings. We're not just reading them. We're going to unpack the market psychology behind them. And I have to say, looking at this dispatch from EBG, the first thing that hits you is just the variety. It's wild.
Oh, it is.
We have everything from, a tiny, unglamorous storage locker in the middle of Kansas to these massive, shiny retail centers in the booming suburbs of Texas.
It really highlights a bifurcated market. That's the theme of 2026. You have this massive split between the safe, boring assets that just print money and then the fixer-uppers, where you really have to sweat for your yield.
Let's start in the trenches then. The under $2 million category. This is where most people dip their toes into commercial real estate, right?
Correct. This is the entry level, but, entry level doesn't mean small money. It just means accessible.
And nothing says accessible quite like self-storage. We have a listing here for a facility in Greenville, Texas. It's 10,000 square feet, built in 2024, and the headline is 100% leased.
Which is just a fascinating commentary on American consumerism, isn't it? The building is barely 2 years old, and it is already stuffed to the gills with people's extra stuff.
The too much stuff economy.
Right.
But from an investment standpoint, this is what you call turnkey.
Exactly. This is for the investor who wants safety. You buy it, the tenants are already there, the building is brand new, so the roof isn't going to leak.
And you just collect the checks.
You just collect the checks. It's a preservation of wealth play.
But then compare that to the very next listing on the sheet. It's another self-storage facility, this time in Topeka, Kansas.
Mm-hmm.
It's nearly double the size, over 18,000 square feet. But the description is totally different. First of all, it has this big tag, off-market.
Now, that is a phrase that gets a certain type of investor very, very excited.
Okay, let's unpack that. If it's in the newsletter, isn't it technically on the market?
Technically, yes. But off-market, in this context, means it's not listed on the public MLS, the multiple listing service. It's not on LoopNet or CoStar, where every amateur with an internet connection can pick it apart.
Huh.
EBG is bringing this directly to their private network.
So it implies exclusivity.
It implies a relationship. And usually it implies a story. When a deal is off-market, it often means the seller wants a quick, quiet exit. Maybe they're tired, maybe they're retiring.
Maybe they need the cash for something else.
Exactly. It usually means less competition, which allows for better deal terms.
And the listing itself confirms that story. It doesn't say 100% leased like the Greenville one. It says value add opportunity and expansion upside.
There it is. Value add. That is the magic word for the ambitious investor.
In plain English, does value add just mean it has problems?
It means profitable problems. It means the property is undermanaged. Maybe the current owner hasn't raised rents in 3 years. Maybe they don't answer the phone, so the occupancy is low.
Right.
Or, as the listing notes here, there is pad-ready space.
Pad ready. That sounds like construction lingo.
It is. It means the dirt is flat, the utilities are there, and you can pour concrete tomorrow. The hard work of zoning and grading is done.
So you aren't just buying a storage unit. You're buying the ability to build more storage units.
Yeah.
Instantly.
Right.
So Greenville is for the dentist who wants to play golf on the weekend. Topeka is for the hustler who wants to build an empire.
Precisely. You're trading safety for potential. In Topeka, you have to work to unlock that value.
Staying in this under $2 million bracket, there's another niche here that I found really surprising. Tiny, and I mean tiny medical offices. There's a listing in Plano, Texas for a unit near Willow Bend that is only 756 square feet.
I have seen master closets bigger than that.
Right. Why would anyone invest in a 700 square foot office? You can't fit a company in there.
No, but you can fit a therapist, or a boutique consultant, or a concierge doctor.
Concierge medicine, that's huge right now.
It is. We are seeing a fragmentation of professional services in 2026. These high-end providers don't want to be in a massive, sterile hospital complex where you have to park in a garage and walk a mile.
No, they want to be somewhere quiet.
They want to be in a quiet, high-end garden office 5 minutes from their wealthy clients' homes.
And Willow Bend is definitely wealthy.
Exactly. It's a demographic play. You aren't betting on the building size. You're betting on the neighborhood's income.
There's another Plano listing right next to it, a slightly larger medical office, about 2,900 square feet. But the note on this one stopped me. It says, owner financing available.
Ah, yes. That tells you a lot about the banking climate in 2026.
It sounds like the seller's desperate. Like, please, I'll be the bank, just take it.
It can be desperation, sure, but often it's just a necessity to get the deal done. We all know traditional banks have tightened their lending standards significantly. Interest rates are what they are. If a seller owns a building free and clear, acting as the lender is a massive strategic advantage.
So the seller basically says, give me a down payment and you pay me the mortgage every month instead of Chase Bank.
Correct. And for a buyer, that is gold. You bypass the red tape, you don't need a bank appraisal that takes 6 weeks.
And you can probably negotiate a better interest rate.
Often, yes. It opens the door for someone to break into a high-barrier market like Plano without needing a massive institutional loan approved on day one.
It's fascinating how these little phrases, owner financing, off-market, reveal the whole texture of the economy. Okay, let's graduate. We're moving up to the $2 million, $5 million bracket. And this category feels, well, it makes me hungry and maybe a little active.
It's the service economy portfolio?
The list is almost comical in how specific it is. We have a gym in McKinney. We have a quick car oil change in Plano, a Wildwood restaurant in Garland. And because this is Texas, we have a gun store, Superior Outfitters, in Terrell.
Guns, gyms, burgers, and oil changes. The 4 food groups of the Texas economy.
But seriously, why are these grouped together? Is there a common thread here?
There is a very strong thread. Think about what you cannot do on the internet.
I can't get my oil changed on the internet.
You can't eat a steak dinner on Zoom. You can't go to the shooting range via email.
Okay.
These are what we call Amazon-proof or internet-resistant businesses. For the last 15 years, retail investors have been terrified of e-commerce. They watched bookstores die, they watched electronic stores vanish. So capital fled into the service economy.
So these listings are seen as the safe harbor.
Exactly. And because they're seen as safe, they command a very specific, very desirable lease structure.
Yeah.
You see it listed for the Wildwood restaurant and the gun store. Absolute NNN.
Triple net. The holy grail.
It really is the dream for a passive investor.
Okay, let's break this down because triple net sounds like jargon. If I rent an apartment, I pay rent. If the toilet breaks, I call the landlord.
Right. And the landlord pays the property taxes, the insurance, the maintenance. That's a gross lease.
But in triple net.
In a triple net lease, the tenant pays the base rent,
Okay.
plus the property taxes, plus the building insurance, plus all the maintenance.
So if the roof caves in on Superior Outfitters.
The owner of the gun store pays for the new roof. You, the landlord, do not write a check.
And if the taxes in Terrell, Texas, go up by 20%.
The tenant pays the difference. You, the landlord, are insulated from inflation in operating costs.
That sounds incredible for the landlord. But why would a tenant agree to that? It sounds like a raw deal.
It's about control and branding. If you are a serious business like a successful restaurant or a national chain, you don't want to rely on a cheap landlord to fix the air conditioning in the middle of July.
Good point.
You want control of your facility, so you agree to cover the costs, and in exchange, you usually get a long-term lease and total autonomy.
The Wildwood listing explicitly says 0 landlord responsibilities, and it lists a 7.25% cap rate. So basically, you buy this building, you get a 7.25% return on your money, and you never have to visit Garland, Texas.
It is the closest thing to owning a bond, but with the tax benefits of real estate. It's mailbox money.
There's one listing here that highlights a 15-year NNN lease. That's the gun store. 15 years is a long time. You are really betting on the longevity of that specific business.
That is the risk. In triple net, the building matters less than the tenant. You aren't underwriting the bricks, you're underwriting the business model. If Superior Outfitters goes bankrupt in year 3, you're stuck with a specialized building designed to sell firearms, and your income stream evaporates.
And I imagine converting a gun range into a daycare is expensive.
Prohibitively so. And the zoning board might have some questions.
So we have the boring storage, we have the service cash cows. Now let's talk about the big money, the $5 million to $10 million range. And this section of the newsletter is dominated by one single word, Selena.
Selena, Texas, the poster child for urban sprawl in 2026.
It is everywhere in this data.
Right.
Retail Center A, Retail Center B, Retail Center C. And the tenants listed are what I like to call the suburban uniform.
Let me guess.
Mobetas, Soak, Torchy's, Pacific Dental, Sport Clips, Five Guys. It feels like every new suburb in America is issued this exact starter pack of stores.
It's the checklist of the upper middle class.
But why? Why are there so many listings in this one town, and why are the tenants always the same?
Well, the why for the town is simple. Demographics. Selena is on Preston Road, which is the main artery of growth north of Dallas. 10 years ago, this was wheat fields. Now, it's endless subdivisions. The developers are pouring concrete as fast as they can because the people are coming.
And the tenants. Why don't we see Joe's local burger shack? Why is it always Five Guys?
That comes down to financing. These centers are brand new construction. The developer took out a massive construction loan to build them. The bank requires that developer to sign tenants with strong credit ratings to guarantee the loan.
Ah, so Joe's burger shack is too risky for the bank.
Exactly. Joe doesn't have a corporate balance sheet. Five Guys does. Pacific Dental does. So the bank effectively curates the shopping center. It creates this homogenization, sure, but for the investor buying the center, it provides safety. These are national brands.
The listing emphasizes new construction and rent bumps. Now, usually buying brand new is expensive. You're paying top dollar. Why is it smart?
Because you are buying into the growth curve. These tenants, Torchy's, Pacific Dental, they have teams of data scientists. They know exactly how many households are moving to Selena next year. They know the traffic counts on Preston Road.
Ah.
If they're signing a lease, it's because their data says the money is there.
So when you buy one of these centers, you're basically piggybacking on their research.
You are outsourcing your due diligence to corporate America.
Now, within this big money bracket, there is one listing that stands out as the ultimate safety play. It's not in Selena, it's in Waxahachie. It's an 11,000 square foot center. But the magic words in the listing are grocery anchored.
The gold standard.
Why is a grocery store the kingmaker in retail?
Frequency. Think about your own life. How often do you go to the dentist?
Twice a year. I'm being good.
How often do you go to the gun store?
Rarely.
How often do you go to the grocery store?
Twice a week. Minimum.
Exactly. A grocery store is a gravity well. It pulls thousands of people into that parking lot every single week, rain or shine. And while they are there, they drop off their dry cleaning, they grab a sandwich, they get a manicure.
It's the spillover effect.
It's cross-shopping.
Right.
And critically, it is recession-proof. In a downturn, people might cancel the gym membership, they might stop buying new clothes, they do not stop eating.
Right.
So if you own the small shops next to a grocery store, you are protected by that anchor.
So Waxahachie is the defensive play and Selena is the aggressive growth play.
Exactly.
Okay, we have covered the boring stuff, the service stuff, and the sprawl. Now I want to get to the final section of the newsletter.
Yeah.
This is the stuff that feels, well, adventurous.
This is the strategic category, land and potential.
This is where the math gets fuzzy and the psychology gets intense. Let's start with this 37-acre plot in Cedar Hill, Texas. It's residential land, but there's no price tag. It just says sealed bid opportunity.
Psychological warfare?
That sounds like a movie plot. Sealed bid. What is actually happening here?
So this is a CHSD asset sale that stands for Cedar Hill Independent School District. The school district owns this land. They don't need it, so they're selling it. But as a public entity, they have a duty to get the maximum price. A sealed bid creates a pressure cooker.
Because you don't know who you're bidding against.
Exactly. In a normal real estate deal, you offer $2 million, I counter at 2.5, we settle at 2.25. We talk.
Right.
In a sealed bid, you have one shot. You have to put your absolute best number in that envelope by the deadline.
That sounds terrifying.
It is. If you bid too low, you lose the deal instantly. If you bid too high, you suffer the winner's curse. You won the land, but you might have paid $1 million more than the next guy.
Wow.
You overpaid because you were bidding against a ghost.
Why would any investor subject themselves to that stress?
Because the prize is worth it. 37 acres zoned for residential in a growing area like Cedar Hill. You could build hundreds of homes there. The upside, the potential profit, is high enough that developers are willing to play the game.
From the poker table of sealed bids to the, let's call it the grind set of Hearst, Texas. There is an industrial park listed here, 41,000 square feet. And the expert analysis note on this one is screaming at me. It says, rents 65% below market.
This is my favorite listing in the entire deck.
How is that a good thing? You're buying a building that is losing money.
No. You are buying a building where the money is currently being left on the table. 65% below market is a neon sign that says mismanagement.
Or just a really nice landlord.
A landlord who hates making money? Maybe. Look, maybe they signed 20-year leases back in 2005 and never put in an escalation clause. Maybe they just checked out.
Right.
But the listing notes, short-term leases. That is the key.
So what's the strategy?
Yeah.
You buy it and kick everyone out.
You don't have to kick them out. You buy the building. You wait 6 months for the leases to expire. Then you knock on the tenant's door and have a very difficult conversation. You say, hi, you've been paying $4 a foot. The market rate is $12. Your new rent is $11.
Ouch. That is a brutal conversation. You're nearly tripling their rent.
It is. And the tenant might leave. In fact, you might want them to leave so you can renovate and bring in a better tenant who can pay the full $12. This is not passive. This is conflict. It's aggressive management. But if you pull it off, you triple the income of the building, which effectively triples the value of the asset. That is how you turn a $3 million building into a $9 million building in 24 months.
That is the value-add strategy in its purest, most aggressive form.
Correct. High effort, high reward.
And finally, let's look at the land in Mesquite. 2.2 acres. It mentions mixed-use zoning and up to 84 apartments plus retail possible. But the note that caught my eye is, city supports corridor redevelopment efforts.
That is code for the city will help you get the permits.
Which is rare, isn't it? Usually developers are fighting the city tooth and nail.
Usually, yes. But Mesquite, like a lot of older suburbs in the Metroplex, is trying to reinvent itself. They don't want more sprawl. They want density. They want a vertical village. They want young professionals living in apartments on top of coffee shops.
So if you come in with a plan to build that, the city isn't an enemy. They are a partner.
Exactly. They might fast-track your zoning. They might even give you tax incentives. This is a policy play. You are aligning your investment capital with the political goals of the city. When you swim with the current of local politics, you tend to go faster.
So we have really traversed the entire landscape here. We've gone from the fixer-upper storage unit in Topeka to the set-it-and-forget-it gun store in Terrell. We've looked at the credit-fueled sprawl of Salina and the high-stakes poker of Cedar Hill.
It's a full ecosystem.
And what strikes me, looking at all of this together, is that barbell shape we talked about at the start. It feels like the middle ground is dead. You either buy extreme safety, those triple-net grocery-anchored deals, or you buy extreme potential, the value-add industrial, the raw land.
That is the defining characteristic of the 2026 market, according to this EBG data. The market rewards safety, and it rewards hard work. It punishes mediocrity. There is very little room for just holding average assets anymore. You need a strategy.
Before we wrap up, I want to leave you, the listener, with one thought. A provocation, maybe?
Let's hear it.
We talked a lot about these Amazon-proof businesses. The gym, the oil change, the burger joint. The entire premise of that multi-million-dollar service economy sector is that these businesses are safe because the internet couldn't kill them.
Right. You can't digitalize a calorie. You can't download a bicep curl.
But we are looking at this snapshot in January 2026. If we look forward to 2030 or 2035, technology doesn't stop. We're seeing electric vehicles take a massive market share. EVs have far fewer moving parts than gas cars. They don't need oil changes.
That is a massive existential threat to the quick car model. If there's no oil to change, what happens to that building? It's just a pit in the ground.
Exactly. And look at the food tenants. We're seeing robotics in kitchens. We're seeing the long-term impact of Ozempic and GLP-1 drugs changing how people eat. Does the Five Guys franchise model hold up if calorie consumption drops by 20% across the population?
It raises a very uncomfortable question for those safe investors. We think these assets are safe because they survived the last war, the e-commerce war. But are they ready for the next war, the automation and biology war?
It's something to chew on next time you're sitting in the drive-thru.
Or waiting for your oil change? Well, you still can.
Huge thanks to Joseph Goslan and the Eureka Business Group for these data points. It is fascinating to peek behind the curtain.
Always a pleasure to follow the money.
And to you, listening in. Thanks for taking the deep dive with us. We'll see you next time.